In this week's video, we'll review a wide range of fundamental, technical, and historical data to help us answer 8 difficult questions about the sustainability of the stock market rally. We'll be moving quickly, so feel free to use the pause button on your video player. Before we get into the longer-term questions, let's quickly review the current state of the market as of the close on Thursday, July 2nd. 200-week moving average, upward sloping. It is the 13th consecutive close above that upward sloping 200-week moving average. That speaks to the longer-term outlook. In fact, this entire video speaks to the longer-term outlook. Doesn't really talk about the next 3 hours, next week, the next 3 days, or really even the next 3 weeks. This is the drawdown chart that we've been covering for our momentum thrust cases that we covered a few weeks ago. Even under really good longer-term outcomes historically, you had to withstand drawdowns back to these lines here. That could be as painful as 2,800 in the present day. This chart is dated June 24th. The week of July 2nd, the S&P 500 was up over 4%. You can see we're back above this blue line here. But we really don't have any resolution relative to this consolidation box here, reminding us to keep an open mind about a wide range of outcomes, especially in the next few weeks. Covered this study last week. Historically, really good things happen from a longer-term perspective. The median drawdown, painful, underneath 2,900 relative to a hypothetical on a 2020 chart. Nothing particularly alarming has occurred relative to any of the studies and drawdown charts and tables that we've presented since the market bottomed on March 23rd. That is obviously subject to change. A chart like this can help us with probabilities. Either way, we'll see how it unfolds in the coming weeks. As we've covered numerous times in recent weeks and months, the bearish case tends to get a lot of coverage and hence tends to be easier to understand. Not so with the bullish case. So let's get right into some of the nagging questions about the bullish case, including, what about the still elevated VIX? This is a weekly chart of the S&P 500 index dated June 19, 2020. The top portion of the chart is the S&P 500. This is Williams percent R. It measures momentum. And this is the volatility index, or the VIX, on the bottom of the screen. It's very, very easy to forget how painful it was just a few short weeks ago. March 20th headline, Dow drops more than 900 points. Oil dips below 20 as Wall Street wraps up worst week since 2008. It's March 20th of this year. We all remember we had a very, very scary drop in the stock market. Elevated and rare readings on the VIX on the bottom of the screen, an incredibly weak momentum. This drop and these headlines speak to scarred investors in the present day. Here's the same chart, but now we've taken it all the way out to June 19th, 2020. We've had a massive move off the bottom, and hence we have strong momentum as of June 19th. Despite this massive rally and this strong momentum, we still have a lot of fear and skepticism in the market as measured by the VIX that was over 33 on June 19th. A high degree of fear and skepticism is really not difficult to understand in this context here. Let's compare and contrast this period with the look of Williams percent R and the VIX on February 28th of this year. Their readings significantly different from a momentum perspective. The VIX is still above 33, similar to June 19th. But momentum, instead of being in quote-unquote overbought territory as it was on June 19th, it's in oversold territory below negative 80. This would represent a more typical and common pair. This is atypical. Therefore, it might be helpful to know, how many times has something like this happened in the history of the VIX that dates all the way back to 1990? It's only happened in one other period, 2008, 2009. The first instance came on April 17th, 2009. You can see the chart in 2008, 2009 has a lot of similar characteristics. A scary drop, rare VIX readings, low momentum readings. Then we get a strong rally off of the March 9th low. Strong momentum, it gets above -20, overbought. And the VIX is still sitting above 33. Very, very similar to the look on June 19th of 2020. Interesting to note, something in 2008, 2009 is tied to the present day or June, July of 2020. 79 calendar days ago, on April 14th, we also performed a study about something that happened in the present day that tied the present day to March of 2009. Thus, if this analogy here still holds water, it's not particularly surprising that we're seeing similarities between 2008 and 2009 months down the road in late June and or early July. It's probably pretty fair to say the look of this chart in the present day aligns with, rather than contradicts, the findings back in April of this year. So if a look like this has only happened one other time between 1990 and the present day, it might be helpful to know how the S&P 500 performed walking forward in the previous instance. April 17th of 2009, very, very similar to June of 2020. Here's the S&P 500 right here in April. Walking forward, really good things continue to happen for several more months into the spring of 2010. From April 17th of 2009, the S&P 500 tacked on an additional 40% in round figures. How about the maximum drawdown? Relatively muted. It's right here. It happened very, very quickly. A 4.28% drop from April 17th, and then the rally continued. Therefore, from a realistic expectations perspective, a similar drawdown relative to the date of the signal, the first instance in 2020, a 4.2% drawdown from the date of that signal, would say it wouldn't be shocking if the S&P 500 backtracked all the way to 2911. And in this case, if you were able to stay invested during this drawdown here, might be helpful to know how the S&P 500 performed walking forward from April 17th of 2009 from a longer-term perspective. The answer is extremely well, looking out 2 weeks to 5 years. 1 year later, the index was 37% higher. 2 years later, it was 51% higher. 5 years later, over 100% higher. Keep in mind, this is the only other period in the history of the VIX that dates back to 1990 that saw something similar. Sometimes it can be helpful for clients to hear a similar message from a different voice. It's a Bloomberg article dated June 29th. You can pause your video player. Tony Dwyer, here's his Twitter handle right here where my cursor is. Also talking about rate of change, market breadth, momentum, and fear. From a momentum and fear perspective, we just examined it with Williams %R for momentum and the VIX. Tony takes a similar approach. He used stochastics and the VIX. Thus, we wondered what happened if we performed a similar study, but instead used the full stochastic indicator on a weekly chart. Here's the look on June 12th. Strong momentum with the full stochastic indicator above 70. High degree of fear and skepticism with the VIX greater than 30. How many times has something similar happened in the history of the VIX? The answer is the first instance that we saw after a major low, only 4 times. And subsequent stock market performance aligns with the same message that we've been delivering for several weeks now. It allows us, as long as the data holds up, to take a longer-term focus. Looking out 2 months to 2 years, 100% of the similar historical cases, the S&P 500 was higher. Average gain 6 months later was 17%. 1 year later, almost 25%. 2 years later, the average gain was almost 35%. The study also helps us with the all-important realistic expectations about 100% normal and to be expected volatility. There's a 3% pullback, almost a 3% pullback 6 weeks later. This study also helps us understand the need at some point in the future, whether it's 3 days from now, 3 weeks from now, or 3 years from now, for some type of defensive migration strategy. We will reduce our exposure to stocks and increase our exposure to defensive assets. But the main takeaway is very, very similar to the main takeaway from the study that was published on April 14th, right in here on this chart. Both studies help us keep an open mind about better than expected outcomes walking forward. We don't trade this study, and we don't trade the study from April. We trade the chart in front of us. Between early April of this year and the present day, the chart in front of us has aligned with the keep an open mind hypothesis. As long as that's the case, we stay the course. If it changes, we make the necessary adjustments. We all know there's no free lunch in the stock market. Volatility, unfortunately, is part of the equation. How about in these 4 historical cases, the maximum drawdown from the date of the signal or the first instance? Average drawdown was 3.44%. The median drawdown was 2.73%. The max drawdown, 2011 case, was almost 8%. If we put those on a 2020 chart from the date of the signal in 2020, it tells us if you want to make it out here on this table or out here on this table, in the historical cases, you had to withstand drawdowns that were similar to the levels shown on this chart here. Even if really, really good things happen, it wouldn't be shocking if the S&P 500 backtracked all the way to 2,800. And that is not a new message. That is a message that we've been delivering for several weeks now via several different studies. This study was based on the VIX in part. Last week we covered the VIX from a totally different perspective. You can find it in our Twitter feed via the link here. Before we examine question number 2, it's extremely important to note all 8 of these questions are legitimate and concerning questions about the sustainability of the bull market. What we're trying to discern is how concerning are they, and in isolation, are they necessarily showstoppers for the stock market rally? Second question, what about the put-call ratio? We covered this chart or a similar version of this chart a few weeks ago, and it is concerning in the present day. It's equity put-call ratio. When it's up here, you can say this is fear. When it's down here, you can say it's complacency. There's a lot of different ways to look at this. You can look at the 5-day moving average, the 15-day moving average. They all say similar things recently. You can make an argument that this is extreme complacency with a very, very low and rare reading, and that is a legitimate concern. So let's take this same symbol, $CPCE, and look at it from a different perspective. Remember, when the put-call ratio is way up here, you can argue this is extremely high fear, and when it's down here, you can argue that it's extreme complacency. This is an incredibly big shift going from the green line to the orange line, a similar incredibly big shift from the green line to the orange line. But one significant difference, the shift in the present day took 83 days. The exact same shift in this case took 510 calendar days or 1.4 years. And remember, this speaks to sentiment. Do we really think that sentiment and complacency moved in a similar manner over 83 days relative to 1.4 years? We have to remember, we're talking about human beings here. So when we get to the very, very concerning and rare level of complacency in April of 2010, what do we have in the rearview mirror? It passes the common sense test. This is the S&P 500 here. If we look backwards, you can understand how people would become complacent. The market just keeps going up and up. So if you buy, there's no risk. There's no risk. you can see how people would be complacent. This is typical. This is atypical. Here's another way to think about it. In the present day, this headline here, Dow drops more than 900 points, is fresh in everyone's mind. How many times in the past 6 weeks, reading an article about the economy, have you seen the word grim? Thus, it's very hard to make the argument with this in the rearview mirror right here, that the psychology of investors is the same here as it was down here in April of 2010. In April of 2010, we don't have a scary headline like that 83 or 90 days in the rearview mirror. Maximum fear in this case, which is similar to maximum fear that we saw in March, it took 83 days to dissipate that fear. It took 510 days in this case. And that's not just a theory. It aligns perfectly with these numbers. American Association of Individual Investors, last week we showed you that 48% of them, or 49% of them, were bearish. That is the exact same measure of sentiment look in April of 2010. Almost the polar opposite. This is 48 or 49% bears. This is 48% bulls. It's a third-party chart that we found. They would consider the reading in April of 2010 to be extreme bullishness, which aligns with complacency. It's very, very difficult to make a rational argument that we have extreme complacency in the present day, and that investors are overconfident in a similar way 83 days after the peak of fear relative to their overconfidence 510 or 1.4 years after the peak of fear. None of this takes away this reading here and the fact that it absolutely positively is rare and concerning. We're just trying to understand context and understand not only how are they similar, but how might these periods be different. All of that simply helps us keep an open mind about a wide range of outcomes. We're not making the case that this reading here is necessarily bullish. However, when the market was complacent here in April of 2010, it did experience a big drawdown. When we were complacent recently, we have experienced a drawdown. What happened after this drawdown in April of 2010? Was it the end of the world, the start of a new horrible and devastating bear market? No. When this indicator was down here after a 16% drawdown, which is extremely painful, the S&P 500 rallied for over 9 years and gained over 200%. This level here, similar to the present day, simply telling us this level here was followed by significant volatility and a 16% drawdown in this case. But after that, really, really good things happened. So the theory basically is a very, very sharp drop in concern and fear is significantly different from a drop that takes 1.5 to 2 years. Do we have any other data to back that up? Remember, this is high fear, high economic concern, high fear economic concern. It's very, very similar to when we look at the VIX. Recent readings, high fear economic concern. In this case, we'll look at the old formula for the VIX, VXO, because we have data going back 34 years. In the present day, on this chart, we have a very similar and rapid drop from high fear to quote-unquote complacency. Basically seeing the same thing on this chart as of June 30th, 2020. The 69 trading day rate of change, huge drop. Why 69 days? It's been 69 trading days since the major low was made on March 23rd of 2020. We didn't arbitrarily pick the 69. How many times in the history of the VIX have we seen a similar collapse like this? The answer? There's only one case in the history of the old formula VIX dating back to the mid-1980s that's even remotely close. June 30th of 2020 is similar to January 22nd of 1988. Thus, it might be helpful to know, if we take January 22nd, 1988 and walk forward in the S&P 500, what happened? The answer is really good things continued to happen for a long period of time. The additional gain from January 22nd, 1988, which is similar to June 30th of 2020, was over 49%. What about the maximum drawdown? There was not a maximum drawdown. The market never looked back in this case. Very, very similar to the opening study presented in this video. This chart is dated June 30th of 2020. We're tying the present day to the post-1987 crash period. Clients and regular viewers know that we have mentioned 1987 numerous times in recent weeks, including via this slide way back on April 10th. The chart was dated April 9th. We basically said, when you get this oversold, it's extremely rare. And we were already noting similarities to the drop in 1987, the drop in 2009, and the present day drop. That's 84 calendar days ago, and we're tying the same period to the present day on June 30th of 2020. What about consumer behavior and the concern that behavior will be permanently altered by the virus? This is a picture of a beach in Europe taken in late June 2020. This is a tweet July 1st. United Airlines executive says, lots of demand for July 4th weekend, no major spike in cancellations. We have plenty of anecdotal evidence that tells us once the virus is semi under control, consumers will most likely go back to their old habits. It's very, very difficult to say that people are overly fearful in this picture here. Might be the other way around relative to the virus. We're not making any commentary on this slide about the virus itself. We're talking about the willingness of consumers to go back to their old habits when they feel safe again. When they feel safe again falls under the to be determined category. Nasdaq Technical Index weekly, 2000 to 2002 bear market, 2007 to 2009 bear market. It's making a series of lower highs and lower lows. Bollinger Bands, for the most part, are trending downward. This is a classic downtrend, and this is a classic downtrend. Notice there really are no major significant new highs made in this downtrend. This is lower than this, this is lower than this, this is lower than this. How does the exact same indicator look today? It just printed a new all-time closing high. Look at the slope of the center line, the slope of the center line, and the slope of the center line. Like everything that we're covering in this week's video, it doesn't predict anything. It simply helps us with the probability of good things happening relative to the probability of bad things happening. Do we have anything else in hand that tells us the present day really doesn't look like a devastating bear market anymore? Yes. It's a monthly chart. Bullish moving average crossover, blue above red, July 1st. We also had the bullish cross as of the end of June. Blue, the fastest moving average, is on top, and the slopes of both moving averages are up. What about the top-heavy market? It's just a handful of stocks that are leading everything. You can pause your video player. We've been in this business a long, long time. That objection has been around a long, long time. Why? Because that's the way it's always been. This chart dates back to 1927. This is not a new concept, and it passes the common sense test. There's typically a handful of companies, 5 to 20 to 50, that are innovating in a way that are radically different than the other companies. Hence, they are bid up in a different way, and their market capitalization is higher. What wouldn't make sense would be that if every single company had the exact same market cap. And this has nothing to do with opinions about this question. Here's the data right here. IWB tracks 1,000 companies. We all know the S&P 500 tracks 500. Hence, you can make an argument this is a broader index. Low 2009, IWB relative to the S&P 500. This is the rally broadening out, a topic we've been talking about for several weeks or months now. We said this needed to happen. RSI monthly crosses 50 here. Where does that happen? Basically April of 2009. We already talked about April of 2009 earlier in this video. This look here, similar to this look here at the end of June, RSI has recaptured 50. Everything that we said about the last chart applies to this chart. VTI relative to SPY, 2009, 2020. Ditto. Now we're looking at mid caps relative to the S&P 500, 2009, June 30th of 2020. During the bottoming process, 2008, 2009, retail stocks made a big comeback. Here's a look at the same chart on June 30th. Still on asset class behavior, stocks versus bonds, July 1st. Still holding this breakout. What about all the concerning Robin Hood headlines and all the headlines about speculative behavior, people buying bankrupt companies? Is it concerning? Yes, it's concerning. As we said, every single one of these questions is concerning. However, you have to think about the price elasticity of demand. Schwab just took trading commissions down to 0, and everyone in the industry followed suit. Therefore, it's not particularly shocking that trading activity and speculative behavior has increased. The price went to 0. What about valuations? Covered that last week. You can find it via Google. What about weak economic data? Covered this way back on May 1st. Remember, markets historically bottom when the economic data moves from really bad to less bad. Headline, June 30th. Really bad to less bad. Consumer spending habits. Really bad to less bad. Headlines from Bloomberg and Reuters on June 29th. ISM figures July 1st came from really bad to less bad. You can pause your video player. Bloomberg, U.S. companies are providing reason for hope that an earnings recession may be less severe. Less severe? Very similar to less bad. And all of this is taking place within the context of an incredible, unprecedented degree of skepticism. If you look at this tweet here and study it, it's very difficult to make the argument that sentiment in the present day is similar to sentiment on April 15, 2010. Having said that, that doesn't mean some of this data isn't something we should respect. And this is a data set that helps us keep an open mind about worse than expected outcomes. And there's nothing wrong with that. It's incredibly healthy. Why? Because it helps us maintain maximum flexibility. Twitter handle, upper left-hand corner of the screen, June 29th, they put out a dirty dozen chart pack. A lot of good charts in there. Don't want to show them all and steal their thunder. Here's the website here. Here's the Twitter handle here. One of the charts. Vanguard's total stock market index saw its largest 5 days of outflows in over a decade last week. It's very difficult to say that this looks like extreme complacency. You can pause your video player here. It's another example of really bad to less bad. Leading economic index, year-over-year percent change. Things appear to be improving, but they look bad still. Things appear to be improving, but they look bad still. Now we have economic data that's tying the present day to the post-bottom period in 2009. And why is this meaningful? Really bad to less bad? Because history says it's meaningful. It's not an opinion. Basically what this says is stock market returns tend to be the best when this is rising and below 0. Stock market returns tend to be the best when it's rising and below 0, which is basically the identical concept that we covered way back on May 22nd via this slide. The best performance occurs in the stock market in the highest zone of unemployment, the weakest zone of real GDP, and the weakest zone of S&P 500 earnings growth. We wanted to see the economic data go from really bad to less bad, and so far, that's what's happening. Pause your video player. We showed this on May 15th, but it aligns with those concepts. All around the globe, notice here, slow rebound in Europe. When else could we have said slow rebound in Europe from extremely depressed levels? You guessed it, right here in 2009. Another data point tying the present day to 2009. We're not saying the present day is identical to 2009. We're talking about human behavior here. Human behavior in 2009 is similar to human behavior in the present day, including a high degree of skepticism. So this data point ties the present day to 2009. Earlier in the video, we tied present day momentum and fear to the post-bottom period in 2009. 79 calendar days ago, we tied the present day, something that happened in April of 2020, to March of 2009 using market breadth. And we could show countless examples, and we have in recent weeks and months, that asset class behavior has been similar to the post-bottom period in 2009. And all of this recent data tends to align with everything that we've been talking about rather than contradict it. The message that we've been producing with these tables in recent weeks and months is very, very similar to this message here from LPL Research. When really, really good things happen in one quarter, historically, 100% of the cases, the market was higher in the next quarter by almost 10%. 2 quarters later, 100% of the cases, it was higher, average gain roughly 14%. And 1 year later, 87.5% of the cases were higher, with a median gain of 17%. I would say that these numbers here at quarter end align with these numbers here and countless studies and tables that we've shown in recent weeks and months. What about similarities to 1929, 1932, and 1938? We have covered these periods in past videos, so we think the concern is legitimate. However, it's also important to point out today's monetary and fiscal policy could not be more different than the policies 90 years ago. A topic we've been covering in these videos for quite some time. A June 27th Bloomberg headline speaks to the same basic concepts. And there's one incredibly, very, very difficult to argue difference between the 1929 to 1938 period and the present day. Here's the rally off the low in 1932. Notice right in here in 1938, 1933, 1932, we are nowhere near a new all-time high on this major index. We really don't use the term new all-time high in a bear market, and we never historically have used the term new all-time high in a bear market. And yet in the present day, we have the major leading index printing new all-time highs. There are concerns, legitimate concerns about the 1929 to 1938 period, and there are also some significant differences. Remember, the purpose of examining these 8 questions was to answer these 2 additional questions. How concerning are these issues? And historically, have they been showstoppers? There are always legitimate concerns in the stock market. You can come up with something bearish 365 days a year. And the concerns that we've covered are legitimate concerns, concerns that we're respecting. But we're also respecting the weight of the evidence that we've covered since the March 23rd low. The concerns that we have covered help us keep an open mind about worse than expected outcomes. The evidence that we've covered in recent weeks on the other side of the March 23rd low help us keep an open mind about much better than expected outcomes. and we can handle a wide range of outcomes by continuing to trade the chart in front of us. And the only way that we can do that effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.